Welcome back to the deep dive, everybody. Today we're going to be looking at something that, well, I think affects everyone in some way, whether you realize it or not. Natural gas.
Yeah, definitely. It's NG1, if you're watching it in the markets, that's for sure.
And we've got a pretty awesome deep dive prepared here. We've gone through a ton of technical analysis, fundamental analysis, all sorts of stuff to give you the complete picture of where natural gas is headed for the week, starting March 31st, 2025.
We want to make sure that after this deep dive, you don't have to look anywhere else. You've got the full picture.
That's the goal, right?
Yeah.
To make sure that you can just listen to this and be totally up to date. Now, I know that market analysis and all these charts and reports could be a bit overwhelming.
Oh, absolutely. I mean, it can be a real jungle out there.
Right. But that's why we're here to be your expert guides, to break it all down and make it digestible. We've already done the heavy lifting by going through both the technical reports, all that historical price data, and the fundamental reports, which cover things like supply, demand, and the overall market sentiment.
Yeah, and think of it this way. We're giving you the shortcut.
Yeah.
You get to skip all the boring bits and just get right to the important stuff.
Exactly. So for our deep dive today, we'll be looking at the technical analysis, which covers all the historical price data for natural gas up to March 29th, 2025. And then we'll be blending in a contextual analysis, which takes into account those fundamental factors, the overall market mood, and even how natural gas prices might be connected to other markets.
That's where it gets really interesting, right? Seeing how it all ties together.
Yeah, absolutely. But before we get too ahead of ourselves, I always like to remind our listeners that, the technical analysis is based on past data.
Past performance doesn't guarantee future results, as they say.
Right, exactly. And any forecasts that we might discuss here, they're purely for illustrative purposes. Trading always involves risk.
Absolutely. We're just here to give you the tools and information to make the best decisions for yourself.
Right, so our mission for this deep dive is to take all this information, both the technical and the fundamental, and turn it into actionable insights. We want to help you identify those key levels, see where the market might go next week, and understand what factors are likely to drive those price movements. Sound good?
Sounds good to me. Let's jump in.
Okay, so let's start with the big picture. What's the headline story here? What's the executive summary of all this analysis? What's happening with natural gas as we head into next week?
Well, what we're seeing is a market that's kind of in a transition. We're moving out of peak winter heating season and into the spring, what traders often call shoulder season.
The shoulder season.
Okay.
Okay, so that's when the demand for heating starts to drop off a bit.
Right, exactly. And that can lead to some pretty interesting and sometimes conflicting pressures in the market. And it's often when we see increased volatility, as prices adjust.
Okay, increased volatility, that makes sense. So what's the technical analysis telling us? What's the story that the charts are painting?
Well, based on our analysis of the data up to late March, we're seeing natural gas consolidating after some earlier declines. Basically, it's become range-bound, kind of stuck between these defined price levels.
So it's like it's bouncing between a ceiling and a floor.
Exactly. We've got what we call daily supply zones, which act as those ceilings. These are areas on the chart where we've historically seen a lot of selling pressure. It makes it difficult for the price to push higher. And those zones are roughly between 4.38 and 4.55, with even closer resistance, so like a lower ceiling, around 4.08 to 4.15.
4.08 to 4.15. Okay, I've got that. Now what about the floor? What's supporting the price on the downside?
Well, we've identified what we call daily demand zones. These are levels where historically we've seen buyers stepping in, giving the price a boost. These zones are sitting between 3.68 and 3.8, with some extreme lows down around 3.08 to 3.30, suggesting really strong potential buying interest around those areas.
So 3.68 to 3.80 for the daily demand zone, and then some extreme lows down around 3.08 to 3.30.
Okay. Right. And what's really interesting is that when we look at the volume profile, that's basically a tool that shows us where most of the trading activity has happened at different prices. We're seeing a lot of congestion right around that 3.95 to 4.10 area.
Congestion.
Yeah, it's like a traffic jam of buyers and sellers kind of battling it out.
So a real battleground, right? Okay, that gives us a good feel for the technical picture. What about the fundamentals? What real-world factors are going to be driving these price movements?
Okay, so from a fundamental standpoint, we're basically seeing a typical seasonal pattern playing out. As we move into spring, the demand for natural gas for heating, obviously, it starts to decline. People aren't using their furnaces as much.
Makes sense.
Right. And that reduced demand tends to put downward pressure on prices. But here's the thing. There's a very significant counterforce at play right now. the booming demand for liquefied natural gas exports.
LNG exports, yeah, that's been huge.
Exactly. And those exports are providing a lot of support for prices.
Okay, so reduced heating demand, but strong export demand. So it's a bit of a tug of war, kind of like we saw in the technicals.
Yeah, exactly. And then, of course, we always have the wild card, spring weather.
Oh yeah, the weather. Never know what's going to happen.
Right, if we get an unexpected cold snap in April, that could quickly shift the demand picture.
And probably send prices higher, I imagine.
It definitely could. Okay, so we've got these different forces at play.
So given all of this, how are traders feeling about natural gas right now? What's the sentiment?
Sentiment seems to be pretty muted and cautious, which, to be honest, isn't that surprising given that we're in this shoulder season with these opposing forces. There's not a lot of strong conviction in either direction.
So like people are kind of sitting on the fence, waiting to see what happens.
Pretty much.
Okay, so we've got this range-bound technical picture, conflicting fundamental signals, and a cautious market sentiment. What's the combined directional bias here? What are we leaning towards as we head into next week?
Well, putting it all together, the picture leans slightly neutral to bearish. The short-term technical momentum, so the energy behind recent price moves, seems to be weakening a bit, and we're seeing that price struggling to get through that immediate supply zone we talked about, that 4.2 area.
Okay, that lines up with that potential for weaker demand.
Right. And while we do have strong technical demand down at those lower levels, it kind of feels like the path of least resistance, barring any major bullish news, is sideways or potentially down.
Sideways to down. Okay, so we're not ruling out a move higher, but it would really take something significant to push prices up.
Yeah, we'd need a pretty strong catalyst. Something like, a much larger than expected drawdown in natural gas inventories reported by the EIA, a sudden shift to much colder weather forecasts, or maybe some unexpected news that could boost LNG exports even further. Those are the sorts of things that could really change the game.
Okay, so those are things to definitely watch out for. Now, given this uncertainty, what's the primary price range that we should be keeping an eye on for next week?
I'd say that the primary technical range that reflects this fundamental uncertainty is roughly between 3.70 and 4.15.
Okay, so 3.70 as a potential bottom and 4.15 as a potential top.
Yeah, those are the boundaries to watch, the levels where we might see some breaks and more sustained moves.
Okay, got it. And given all these conflicting factors and this lack of conviction, how confident are we in this overall assessment?
Well, honestly, with the neutral technical signals within that range and the opposing fundamental forces of potentially weaker seasonal demand versus those robust LNG exports, our confidence score, if you will, is only about a 5 out of 10.
So not super high conviction.
Yeah, not yet. And that's exactly why it's so important to watch for confirmation around those key supply and demand zones. It's all about seeing how the market reacts at those levels. It'll help us get a better sense of where we might be headed.
Okay, makes sense. Now, I think it's time to really delve into the technical analysis. You mentioned it's based on data up to March 29th, 2025. Let's break down what those different timeframes are telling us from the weekly charts down to the hourly views.
Sure. Looking at the bigger picture, the weekly chart is showing an overall trend that we'd classify as down or corrective, meaning we've seen a longer-term downward bias. But more recently, it's kind of shifted into a more neutral, range-bound pattern.
Okay, so like the longer-term downtrend might be losing steam.
Potentially, yeah. And when we zoom into the daily chart, it's a similar story. We're seeing that same shift from an overall down or correcting trend in the earlier part of our data to a more neutral or ranging pattern throughout March. Interestingly, the price right now is hovering around that 20-day moving average, but it's still below the 50-day moving average, which is a slightly longer-term trend indicator.
Okay, so mixed signals on the daily chart as well.
Exactly. Now, if we look at even shorter time frames, the 4-hour chart, for example, we started seeing a neutral to downside bias develop in late March, with the price consolidating below that 4.9 resistance level.
Okay, so starting to lean a bit more bearish in the short term.
Yeah, and on the 1-hour chart, in the last 24 to 38 hours of our data, the trend was looking even more sideways to down, which could indicate some very short-term downward pressure.
Okay, so short term, potentially a bit weaker, but the longer term picture is still a bit mixed. Now let's talk about those key demand and supply zones again. Where exactly are they and what makes them so important for understanding potential price moves?
Okay, so let's start with the daily supply. We have what we call SE1 daily, which is sitting between 4.380 and 4.551. What's interesting about this zone is that it marks the starting point of that big drop we saw in late February, a drop-base drop pattern.
Okay, so a pretty strong signal that sellers were in control at that level.
Right. And then we also have SE2 daily up around 4.901, but this one is based on a very brief spike high back on March 10th, so it might be a bit less reliable.
Okay, so maybe not as much weight should be given to that one. What about the 4-hour chart? Any interesting supply zones there?
Yes, on the 4-hour chart, we've got SC14H, which is between 4.11 and 4.15. This one seems to be weakening a bit. It's been tested a few times recently without really holding.
Okay, so sellers might not be as strong there anymore.
Right. And then we have SC24H, which is a more validated immediate supply zone between 4.08 and 4.11. This one has seen some recent failures to break through, so it suggests that sellers are still pretty active around that area.
Okay, so that 4.08 to 4.11 zone is one to definitely watch out for. What about demand? Where are the price levels where buyers have historically stepped in?
Okay. On the daily demand side, we've got DZ1 daily, located between 3.794 and 3.683. This was actually the starting point for that rally we saw back in late January, a rally-based rally pattern.
So a strong indication that buyers were in control at that level.
Yeah, and what's really interesting is that we actually saw a reaction in this zone in late March, suggesting that it still holds some influence.
So it's like a level that buyers are remembering.
Exactly. Then we have DZ2 daily, down around 3.08 to 3.30. This is an area of extreme demand, marking the start of that big February rally.
And that hasn't been tested much since then, right?
Right, it's pretty fresh.
Okay, so potentially a very strong support level if we get down there. Anything interesting on the 4-hour chart for demand?
Yeah, we see a minor demand zone, DZ14H, around 3.82 to 3.86. It's been tested a few times, so it could offer some short-term support.
Got it. So we've got all these zones, these potential reversal areas. Now, are there any specific support and resistance levels that traders should be keeping in mind?
Absolutely. So in addition to the zones, we've got these key horizontal support and resistance levels. These are just price points where the market has historically struggled to move past.
So like psychological barriers for the price?
Kinda, yeah. On the resistance side, we're looking at about 4.0, then 4.20, a cluster of resistance around 4.48 to 4.55, and then further up at 490.
Those are the levels where selling pressure might kick in, right?
Exactly. Now for support, we've got levels around 4.05, 3.95, a zone between 3.80 and 3.85, then down at 3.68, and finally that extreme low around 3.08. We also need to consider the daily and weekly pivot points. These are mathematically calculated support and resistance levels.
Okay, so based on those recent highs, lows, and closing prices.
Exactly. For this particular week, the daily pivot point is sitting at 4.031, with resistance 1 at 4.202 and support 1 at 3.887. Then there's resistance 2 at 4.346 and support 2 at 3.7170. What's interesting here is that the pivot point itself is right in that area of congestion we discussed earlier.
The 3.95 to 4.9 zone.
Right. Support 1 lines up pretty nicely with that minor 4-hour demand zone in the top part of the daily demand zone, and resistance 1 is close to some previous highs.
So it all seems to be kind of lining up, painting a pretty clear picture.
It is. It's all about looking for those confirmations. Now, we also need to consider chart patterns.
Right, those visual clues that technical analysts use.
Yeah, so on the daily chart, it's a bit of a mixed bag. We could be seeing a large bear flag or descending triangle forming, which usually hints at more downside to come. But there's also a potential double bottom forming in that 3.7 to 3.80 range, which could be a bullish reversal signal.
So a bit of a tug of war there, too. What about the shorter time frames?
Well, on the 4-hour and 1-hour charts, the recent consolidation below 4-point NOMER kind of looks like a smaller bear flag or just a sideways range.
So those are pointing to more sideways or maybe downward movement in the very short term.
Yeah, potentially. Okay, so we've looked at chart patterns. Let's move on to technical indicators.
Right, those mathematical calculations based on price and volume.
Okay, so starting with the moving averages, the daily chart is neutral, but the 4-hour and 1-hour charts are showing a bearish bias.
Okay, so shorter term indicators leaning more bearish. What about momentum indicators like RSI?
The RSI is neutral on the daily chart, but weak on the 4-hour, and even approaching oversold on the 1-hour.
Oversold, so that can mean we're due for a bounce.
It could, but we need confirmation. The MACD is neutral on the daily, bearish on the 4-hour and 1-hour. The stochastic oscillator, another momentum indicator, is neutral on the daily but showing a bearish cross on the 4-hour and oversold on the 1-hour, so similar to the RSI.
Okay, so potentially some early signs of a bounce, but again, we need confirmation. What about the Bollinger Bands? Are those telling us anything about volatility?
Yeah, Bollinger Bands on the daily chart show the price right in the middle of the range. But on the 4-hour, the price is below the middle band, and on the 1-hour, it's riding the lower band, which often suggests continuing downward pressure.
Okay. And what about the average true range? What's that telling us?
The daily ATR is around 0.18, so we can expect daily price swings of about 18 cents on average.
18 cents, all right. What about the volume profile? What's that revealing about potential support and resistance?
So the volume profile over the past couple weeks shows the point of control, the VPOC, sitting at 4.05 to 4.08.
And that's the price level with the highest volume, right?
Exactly, and it's acting as immediate resistance right now. We've also got high volume nodes, or HVNs, at 3.95 to 3.98 and 4.0 to 4.12. Those could act as support or resistance.
Okay. And then low volume nodes, or LVNs, are at 4.0 to 4.03 and below 3.90.
Right. So bringing all this together, what does it mean for the week ahead? Well, it looks like we're leaning bearish in the short term. The 1-hour and 4-hour indicators are pointing down, and the price is below key moving averages and Bollinger Bands. But on the daily chart, things are more neutral, with the price stuck in this range between 3.80 and 4.40.
So basically, the short term is a bit weak, but the longer term is still undecided. Okay, let's move on to the fundamental analysis now. You mentioned that weather, production levels, and LNG exports are the big drivers. Can you elaborate on how these factors are shaping market?
Of course.
Yeah.
Right now, the big story is the transition to spring, the shoulder season. As we move away from winter, the demand for natural gas used for heating naturally drops. This typically puts downward pressure on prices.
Makes sense.
At the same time, natural gas production in the U.S. is strong, driven by efficient drilling and ample reserves. This also puts downward pressure on prices.
Okay, so two bearish factors.
Right. But here's the bullish counterpoint. Global demand for U.S. LNG exports is robust. This is providing strong support for prices.
So those LNG exports are really propping up the market.
Exactly. And it's important to remember that seasonal shifts, like we're seeing now, can often lead to increased price volatility.
That's when those unexpected price swings can happen, right?
Yeah, exactly. Now, speaking of unexpected events, recent news can also have a big impact.
Were there any big developments lately that might affect the outlook for next week?
Well, our analysis didn't show any specific major news events in the last 7 days.
Okay, so nothing earth-shattering. But what kind of news should we be watching out for in general?
Any changes in weather forecasts can really shake things up. If we get a late cold snap or even a really hot spell that boosts demand for air conditioning, prices could react quickly.
Okay, so weather forecasts are one to watch.
Definitely. And then there's the weekly EIA storage report, which comes out every Wednesday.
That's the one that tells us how much natural gas is in storage, right?
Exactly. If the numbers are higher or lower than expected, it can cause some big price moves. And of course, any unexpected disruptions to production, whether it's due to maintenance, weather, or something else, would also be big news.
Okay, so those are the things to watch. Now, looking specifically at the week starting March 31st, are there any key reports that traders should be paying attention to?
Absolutely. First up is the EIA Weekly Natural Gas Storage Report, which is due out on April 3rd.
Wednesday, okay.
Right. This is a high-impact report, so expect some potential price swings after it's released. Then we have the Baker Hughes rig count on April 4th. This one's more about future production trends. If the rig count is rising, it could mean more supply is coming online.
Okay, so the rig count can give us a hint about future prices.
It can. And last but not least, we have the daily NOAA weather outlooks. These are especially important now during the shoulder season.
Yeah, because those forecasts can really influence trading decisions, especially since we're not sure yet how demand will shape up.
Right. Okay, so those are the reports to keep an eye on. Now let's delve a bit deeper into the supply and demand fundamentals. We talked about production and LNG exports, but what about storage levels, consumption, and geopolitical risks?
Right, let's get into the nitty-gritty.
Okay, so natural gas production in the U.S. has been increasing, which puts downward pressure on prices. Inventory levels are key. While our analysis doesn't give us the current exact figure, traders will be watching how those levels compare to the 5-year average.
Okay, so if they're higher than average, it's bearish, because it means we have plenty of supply.
Right, and if they're lower than average, it's bullish. There's also a growing focus on end-of-season storage levels as we head into the summer injection season.
When utilities start building up inventories for next winter. Okay, what about consumption?
Well, as we said, heating demand drops in April. However, the power generation sector is a huge and growing consumer of natural gas. Their demand is driven by weather, especially summer cooling needs, and electricity prices.
Okay, so that's something to keep an eye on as we get closer to summer.
Absolutely. Now, imports are relatively small, but LNG exports are booming, providing crucial support for prices. And speaking of seasonality, April tends to see weaker overall demand than the winter months, which can lead to softer prices or range-bound trading.
And that's what we're seeing right now, right? That range-bound movement.
Exactly. Now, last but not least, there's always geopolitical risk. It can be a major factor in the natural gas market.
Especially with those LNG flows, right?
Right. Disruptions in major producing regions can have a ripple effect globally. Now, our report didn't point to any specific geopolitical risks right now, but it's always something to be mindful of.
Definitely something to keep in the back of our minds. Okay, so we've got a good grasp of the fundamentals. How does all this align with the technical picture we discussed earlier? Are there any confirmations or conflicts?
Well, the weaker demand we're expecting fundamentally does line up with the weakening technical momentum and the price struggling around 4.10.
Okay, so that's a confirmation.
Right. The range-bound trading also reflects the fundamental uncertainty of the shoulder season. But here's a potential conflict. The strong LNG export demand could counteract that seasonal weakness and provide support at those technical demand zones around 3.8.
So that could push prices up, even if the seasonal factors are pointing down.
Exactly. And don't forget about the weather. Unexpected cold could also trigger bounces from those technical support levels.
So fundamentally, there are a lot of forces pulling in different directions. It's going to be interesting to see how it all plays out.
It definitely is. Now, let's move on to sentiment analysis. How are traders feeling about natural gas right now?
Right, let's tap into the collective wisdom, or maybe the collective fear of the market.
Well, as we mentioned earlier, the sentiment seems to be mixed, leaning towards cautious. And that's pretty typical for the shoulder season when the outlook is less clear.
People are hesitant to make big bets when they don't know what's going to happen.
Right. Now, the tricky part is that our report doesn't have a lot of the real-time sentiment data for 2025.
So things like the Commitment of Traders report, options market activity, social media sentiment, those aren't available for our specific analysis period.
Exactly, which makes it a bit harder to gauge the current mood.
Okay, but based on what we do know, what's your assessment of the overall market sentiment?
Well, given that typical shoulder season caution and the lack of a strong fundamental driver, I'd put the composite sentiment score around 45 out of 100.
So slightly leaning towards bearish.
Yeah, reflecting those concerns about weaker demand. And without more specific data, it's difficult to identify any clear contrarian signals. Those signs that the market might be getting too bearish or too bullish.
Okay, so no flashing red or green lights there. But how does this sentiment picture align with the technical analysis?
Well, it seems to align pretty well. The neutral to cautious sentiment matches that range-bound and somewhat mixed technical picture. It doesn't seem like there's any strong sentiment that's contradicting the technical setup.
Okay, so sentiment and technicals are basically on the same page, both kind of sitting on the fence. All right, let's talk about correlations now. How does the price of natural gas typically move with other markets like crude oil or the US dollar?
So our report doesn't have specific correlation coefficients for 2025, but generally those relationships can be pretty complex.
They can change over time, right?
Right, they can be strong one month and weak the next, and they can even shift with the seasons. For example, natural gas and crude oil, they're both energy commodities, so sometimes they move together, but not always.
And what about the US dollar? How does that affect natural gas prices?
Well, the dollar often has an inverse relationship with commodity prices. A strong dollar can make commodities more expensive for buyers using other currencies, which can weaken demand. But again, this relationship isn't always a perfect predictor.
Okay, so it's not a simple one-to-one relationship. So with this uncertainty around correlations, what are some of the key things that traders should keep in mind? What should they be watching in other markets?
Even without precise numbers, it's always good to keep an eye on crude oil and the US dollar. Big moves in those markets can sometimes spill over into other assets, including natural gas. For example, a sharp drop in crude oil prices could put downward pressure on natural gas just because of the overall sentiment in the energy sector.
Okay, so it's about watching for those big sustained moves.
Right, and a strong dollar could make U.S. natural gas more expensive for international buyers, potentially affecting export demand.
So even though we don't know exactly how strong those correlations are right now, it's still worth paying attention.
Exactly. Now, since we don't have that correlation data to confirm or contradict the technical analysis, our technical outlook has to stand on its own.
Okay, so we're relying on those chart patterns and those key levels we talked about.
Right. But it's always smart to be aware that something unexpected in those related markets could change things, especially if those historical correlations were to suddenly become strong again.
Okay, so we need to be prepared for anything. All right, we've covered a lot of ground here. I think it's time to shift gears and talk about risk management.
Absolutely, that's essential.
So what kind of price volatility are we looking at in natural gas right now? And how can traders manage the risks involved?
Well, the daily average true range, the ATR, is around 0.18 USD right now. That means we can expect typical daily price swings of about 18 cents.
Okay, so a decent amount of movement.
Yeah, and don't forget that we can see even bigger moves, especially during the shoulder season and around those big reports like the EIA storage data.
Right, when those numbers come out, things can get pretty wild.
Exactly. So to manage risk, stop loss orders are crucial. And based on those demand and supply zones we talked about, we can set some technically derived stop levels. For example, for a long trade near that DZ1D demand zone around 3.80, a stop loss just below the zone, maybe at 3.67, could make sense. And for a short trade near the SE24H supply zone around 4.08, a stop loss above the zone, maybe at 4.16, could be appropriate.
Okay, so those are some good starting points.
Yeah, but remember, those are just examples based on those specific zones. The best stop level for you will depend on your trading style, your risk tolerance, and how volatile you think the market might get.
Right, so it's not one size fits all.
Exactly. And you also mentioned ATR-based stops. Let's talk about those.
Yeah, how can traders use the average true range to set their stops?
Well, with the current daily ATR at about 0.18 USD, you can set your stop loss based on a multiple of that ATR. So a 1x ATR stop would be 0.18 away from your entry price, a 1.5x ATR stop would be 0.27 away, and a 2x ATR stop would be 0.36 away. The multiple you choose really depends on your personal risk tolerance and the volatility you expect.
Okay, so a higher ATR multiple means a wider stop, which gives the trade more room to breathe, but also increases the potential loss if it gets hit.
Right, it's a trade-off. Now, how does all this relate to position sizing?
Right, that's the million-dollar question. How much should you actually be trading?
Exactly. And that's where things get tricky with natural gas. Let's use that 1.5x ATR stop of 0.27 USD as an example. For a standard NYMEX Natural Gas Futures contract, a 0.27 price move is a $2,700 loss. So if you're following that common risk management rule of not risking more than 2% of your trading capital on a single trade, that means a $10,000 account can only risk $200 per trade.
And with a $2,700 potential loss, even a fraction of a standard contract would exceed that risk limit.
Exactly. So you'd need to look at smaller contract sizes or other instruments that allow for smaller position sizes. And even with a $50,000 account, the 2% risk is only $1,000, which is still less than half that potential loss.
So natural gas can be a really risky market, especially if you're trading those standard contracts.
It is. You've got to be very careful with position sizing, make sure you're trading at a level that you're comfortable with, and consider those wider stop loss levels or smaller position sizes.
Okay, great advice. Now, what about potential risk-reward scenarios based on those key technical levels? What are we looking at there?
Okay, let's say you go long near that DZ1D demand zone around 3.80 with a stop loss at 3.67. If the price rallies to the SC24H supply zone target around 4.0,